Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update. Hope everybody's doing well. We're going to jump right into the numbers here and let you know what's going on in the greater Phoenix area and around the country with the housing news. So, right now, the big news this week was that the inflation report, the rate of increase, and all that was down year over year, which is good for what the Fed is trying to do, whether you agree with what they do or not. They were looking to tame inflation. That has happened again, month over month for the last several months and year over year. And we see that this is part of what they were trying to do with raising the Fed's fund rate, which had our mortgage rates go up late to the party again, like we always talk about. But they did what they did, and we are where we are. And they've been sitting there a little bit too long. Basically, in order to avoid a not a housing recession, but a economic recession, um, or any long-term recessions that we may be running into, even though we had the SOM rule. I talked about that the last couple of videos. Um, they really need to drop the Fed's fund rate. They're kind of should have already done that, but you know, they really need to do that immediately, and they're going to be doing that in mid-September. Um, excuse me. How much they're doing that, we'll have to see. It's probably going to be 25 or 50 basis points. In reality, to get to a neutral position on the Fed fund rate, they probably would have, um, you know, they could do like 8 rate cuts, honestly, if they're doing uh, 25 basis points at a pop. They're being very restrictive, like we've been talking about. So, Jerome Powell doesn't want to lose, on the inflation game, and also they're looking at the unemployment. They want the unemployment to go up, because if unemployment goes up and we put a squeeze on wages, then you see that people are going to be spending less money. However, we see that people are still getting out there and spending money. They just may be doing it on credit. So um, they've pretty much, uh, broken the economy. Now, we haven't seen any huge numbers in the way of unemployment for the unemployment numbers for the construction workers, dealing with single family housing and things like that. So, in order to, really at the start of every recession, we see that that is a factor. Although we see a little softening there, we see that they're, definitely not building as quickly as we would like as far as new single family housing and even multifamily housing. The rental boom definitely has slowed down, and pretty much, uh, ran its course. And those things always have a lag time, of a couple of years almost, as far as build times and all the stuff that it takes to kind of work up to getting those projects going. So those type of things, we definitely are going to keep an eye on. But we know that unemployment rate's up and the rate of inflation is down, although, you know, everything's obviously more expensive because what causes all this inflation, whether it be in housing or food or whatever, well, printing, mainly printing too many dollars, too much funny money. And then we have too many dollars chasing too few goods. Beyond that, also energy policies drive a lot of this too, because it costs, you have to use energy to manufacture and make things and ship things and, move things around or whatever the case may be, in order to house things, all that kind of thing, whether it's just, your regular utility bill to house your products, and your people who are providing the services and all those sorts of things. So all of that comes into play, and all of that definitely, you know, has kept inflation up because of some of those policies. When you take tax dollars and then you divert it to things like in the, this green energy sector, um, and I think I don't know. I've seen many people talking about their electric bills, online on Facebook boards all over town here in the Phoenix area. And yeah, things are obviously going to be higher in the summer months here, um, but people are like can't believe the prices and the rise in the rate of prices and utility bills. And again, all comes back to inflation in general, but there's also that side of policy, right? For just that sector, which then affects everything else. So I've shown you articles on this before. I'm not going to go into great detail on all these things again, but that's kind of what the Fed was trying to tame down with this inflation. And so we see that those two things that they've been watching, and it's really the unemployment numbers more than the inflation rate. But this always works well with the bond market because the bond market's always going to be ahead of this Federal Reserve because they're just slow and old and they take forever to do anything and they have a very restrictive policy um, and old models they're working by. Things move a lot at a lot quicker pace right now. Even in the real estate industry, it used to be thought a balanced market maybe 5 to 7 months. Now with the internet, and all these different, techie things that we use out there, and people being able to, be a lot more mobile than they used to be and all those sorts of things. It's really more, like in a Phoenix area, a balanced market for us is pretty much close to three. So say 3, 4, maybe 5 months supply. It's kind of a balanced market for us. I think for most of the country, 3, 4 months would probably start people in a balanced market, up to about 5 or 6 months. Uh, it's just things move a little bit quicker than they have in the past, with the way people purchase property. So, um, you know, the market trends, we're going to see, uh, we're going to want to see these rates, start, falling even further than they already have. We're going to want to see that continued rate of a decrease in the rates. Now, it all runs off uh, the 10-year treasury, right? So we keep an eye on that 10-year treasury, which we'll talk about here in a second, and that'll tell us where we're at. So that's kind of a big overall picture. I'm going to share my screen here with you and we'll jump right into this. Whoops, sneak peek at the Cromford Market Index. CPI report, inflation falls below 3%. So that was the big news this week. The rate of increase year over year is what they're looking month over month, year over year. So that's under what the expectation was, increase expectation. We were at 2.9. So the rate of increase has slowed. Okay. Month over month the same, but they really look at that year over year. And more importantly, they look at, these different inflation indexes. But what the Fed looks at is the PCE inflation index. So the CPI, which you hear more about usually in the news, um, is excluding food and energy. Core CPI came in, and it talks about it came in at 0.2% monthly rise and a 3.2% annual rate meeting expectations. So, and this goes into the 12-month. So because what the Fed looks at is what they can control, and they can't control necessarily everything in the market. So in their minds, so they're looking at what they can control. So that would take us to the PCE inflation rate, and that has been trending down. So as long as we see that trending down, and not that we're rooting for anybody to lose their jobs, but the jobs report came out a couple weeks ago, and we know that the rate of unemployment, three month average, moving average was 0.5%, increases. That gives us our what they call the SOM rule, or the beginnings of a recession, or signaling a recession. It was up around 4.3%. The Fed looks for, they're comfortable with even a 4.5. So if that continues to rise, though, we're going to see them maybe accelerate those, somewhat accelerate those reductions in the Fed's fund rate, which will affect the bond market. But again, the bond market's always going to be ahead of the Fed. It's just what they signal ahead, and then we go from there. So if we look at the 10-year treasury, which we'll keep an eye on because that's going to be the main factor. 2 year is going to be more of which we had some really erratic stuff a couple months back with that. But that's going to be more of the day-to-day stuff. This is the more of the long haul, what's the trajectory there of this 10-year. And we saw this right now is at 3.8. Let's see, let me get that in there. 3.9, 3.8, yeah, or 3.9 today, in the last 24 hours. So that gives us our split. So between when we say the splits, that's the 10-year treasury there at 3.9, and where we are with the average mortgage rates. Um, by the way, here's a quick, and I'm going to get into the mortgage rates in a minute. Here's a quick history, going back to the 1965 of the 10-year treasury. You can kind of correlate this. Typically, in a normal setting, about 1.75 to 2 points difference between the 10-year treasury and what mortgage rates are. Okay, that's normal. We have not been in normal for the last couple of years because we had inverted yield curves and crazy market stuff happening because of all the out of control spending and inflation by the government. So this is a quick look at the history of the 10-year treasury. Now, today's rates reflect a little bit more than what we'd like to see in the splits. So we said, what, 3.9-ish is how we ended the week, where, we should be more like, so based on that, we should be more around these national averages should be more around 5.9 or 6. We're at 6.5. But as those splits get better, and they have been getting better, okay, along with the rates and everything. 'Cause remember, our rates were up above 8% at one point, when the 10-year treasury was, over, what was it, over 5. So, we really got to watch the splits because just the splits getting better and back to normal will give us about 100 basis points drop in our mortgage rate that we're tracking. So, yeah, we got to really, watch that 10-year treasury that'll affect our mortgage rate. But again, bond markets always going to be ahead of the Fed. So if you're thinking about, doing anything or just wondering, should I buy now or not? Waiting till mid-September or waiting till later in the year, you're kind of behind on where the market's headed. Okay, so if you've already made a move or you start making a move now, you're really going to get ahead of that curve. And then from that point, I always suggest, talk about this all the time. We've done it on our own properties, but if you drop, let's say, 20 or 25 basis points on your rates that you can refinance with no out-of-pocket costs, do it. You get the buy down rates now. Do it from the builders and sellers. You're going to get all the deals now. You're going to miss a lot of that competition that's out there. You're going to be able to, um, not be as rushed when you're going out to look at properties that may be sitting a little bit longer right now. That's going to change as rates drop and things become more affordable for home buyers. Everybody's worried about the election. I'm going to tell you something right now. Number one, if let's put it this way, if one side gets in and the economy is run the way it has been run or worse, let's just say, uh, bad economy equals lower mortgage rates, okay, because of the way it works with the bond market. And in turn, housing does well. The only time that wasn't true was during the actual housing crash recession of 2006, 2008. And that was due to oversupply of homes, which led to poor lending practices, neither of which we have anywhere near now. People, about half the country owns their home outright. The, people have, I talk about these numbers all the time. About right now, the average is about $300,000 in equity. The lending practices are totally different. The supply of homes would have to triple in order to, or more in order to get to where we were during the crash. We don't even have 80,000 homes a week coming on the market. We're way below that. During the crash, we had 250 to 400,000, not only with new homes, but then you had the people who sort of sale foreclosure due to people owning homes that shouldn't have. And they hit 250 to 400,000 homes coming on the market. And those people were selling or losing their homes, but they weren't buying for several years because they couldn't. So you had all that extra supply for a sustained period of time. It's like this: we've had higher rates for a sustained period of time. Once the rates go down for a sustained period of time, you're going to see a flood back into the market. You're going to have more competition. You're going to get back into these bidding wars, which you still have on certain properties, certain areas of town in Phoenix area, certain areas of the country, like back east right now that are popular. I'm going to talk about. So those sorts of things you gotta think about ahead. You always want to know when you if I was able to capitalize on Apple, if I was able to capitalize on the market, I want to know when. Well, now is that time. And if we go the other way on the election, okay, let's just put it that way. If we end up the other way, well, we know what that looked like. We had super low interest rates, right? We're probably not going to have those anomaly rates, but due to those economic policies, um, housing did very well. So rates were low. People were able to really take capitalize on those refinances and stuff. That's why people aren't with the way the economy is, people are able to in a lot of cases, and dual household incomes, able to survive because of those years. So either way, it's not going to matter, guys. So the waiting, I'm telling you, get ahead of it now. Miss all that wave of people for 100 basis point drop, 1% drop, which we've already seen about a 150 basis point drop from the peak at 8% on mortgage rate. These are just the averages. Again, with a mortgage broker today, you can pretty much, I've seen, shaved off about a half a percent. I'm sorry, about 50 basis points or a half a percent. Yeah. So, whether it's conventional, FHA, VA, whatever, on these rates. So and you can get what are called buy down programs right now. Your first, second, third year lower, then it stays fixed after that, and you end up somewhere around 4 to 5%, depending on which kind of a terms you have. You could start off as low as we've seen, as low as within the ones or twos your first year, then it goes up a little bit every year from there for 2 to 3 years, and then it stops and it's fixed around 4 to 5%. Those are where those buy down programs are running in right now. Plus, you can get your closing costs paid for. So again, it's kind of a no brainer right now once it kind of computes for people and they go out and sit down with a realtor that knows what they're talking about. You can look at new home, move-in ready new homes, resale homes, whatever, and get these deals now because they're not going to last forever. As the market shifts again, you don't necessarily have as many sellers or builders running these type of programs. Or they cost more to do these type of programs. But right now, the sellers and builders are paying for it. You're not buying down the rate, and the money sits there. So when you go to refinance later, it's not only no out of pocket cost. There's no cost because that money's already been paid for by the seller, the builder, and it sits in the escrow account. So um, here is something that some updated news on some most popular markets people are moving to. I'm not going to get too granular into this, but for the Phoenix area, we don't make it. As a matter of fact, nowhere in the West is making it. Everybody on the East Coast on this list are the most popular markets people are moving to. My favorite would be Tampa. That would be my favorite. Or the North Carolina or Tennessee area. Those would be my favorites. But here's a list of the top 10 of the most popular areas where people are moving to right now. So yeah, West Coast, maybe that'll shift back at some point, but that's I'll drop that in the on social media, and I'll put these articles in our weekly newsletter too. If you don't get that, reach out. I'd love to be able to send that to you. U.S. housing market nears 50 trillion in value as number of $1 trillion metro areas double. So uh, metro areas that have gone up in price to hit these $1 trillion metro numbers. And Phoenix did make that list, um, which means it costs to live here, right? It's not cheap to live in the greater Phoenix area anymore like it used to be. So where are the areas right now? Phoenix and Chicago joining the list of places where the total value of homes tops 1 trillion. Okay. Two New Jersey metros within commuting distance of New York saw the fastest growing in aggregate home value, while Sunbelt Metro grew slowly. Okay. So that's a quick rundown there. The metros with the fastest growing uh, home values, we're not on there either in the greater Phoenix area. There's a top 10 list there. So we've we kind of went way up, but we've kind of gone into balance. We're not like having these giant increases right now. Okay. And I think, part of that's just going to be seasonal. Part of that's going to be the rates, the rate shifts, and people making their moves for work, family, whatever. But I think, with the way we're building here, as far as jobs, that's going to shift. We've got, a lot of tech sector, medical, all kinds of stuff happening here, manufacturing. But, right now it's just kind of leveled off, kind of a normal, nothing crazy. There's no crash. Don't go nuts with the clickbait out there on YouTube. But Metro with slowest growing total home value, there's a top 10 list there. We didn't make that one. So we're just kind of hanging in there. And the $1 trillion club, though, top 10 metro by aggregate home value. And we are number 8 on the top 10. Year over year increase, 52 billion for the greater Phoenix area. Okay. And we just made it over that $1 trillion mark. So take that for what you will. Um, the the next thing I wanted to talk about, and this is interesting. We've got Renter Nation. You got Redfin News. America's renter population is growing 3 times faster than its home ownership population amid rise of home buyer costs. Now, take this within the context, partly of, yes, this is a factor because in a lot of areas it's just too expensive for people to buy with the rates. However, a lot of people just don't know also what they don't know. What I mean is this. Um, I looked, I just to kind of give you some quick numbers. These buy down programs are starting to ones, with this, like, with a few particular builders, and you need to be able to qualify for the end result payment, which, first 2 or 3 years. So let's say you end up at, let's say at 4. So you need to be able to qualify for that interest rate, even though your first year you're starting into ones. So I looked up one in Surprise, for instance, and it was a move-in ready home at $400,000. Okay, like literally right at 400,000, like $850 or some, off oddball number like that. And the first year payment on that, though, the first year payment on that was like 1,700 a month. Okay, so um, when you look at what people are paying for rent, that's kind of like in the greater Phoenix area, even for like an apartment. That's about the best I've seen or heard of for a place that, isn't going to be roach infested and falling apart on you. Okay. So, uh, when you look at our average lease price in the greater Phoenix area at the end of July was 2387 a month. Now, granted, that's thrown in with, Phoenix, Scottsdale, the whole greater Phoenix area. Yeah, and there's your residential sales numbers, median sales, average sales. Um, and sales have certainly slowed down, and it's certainly, again, it's more expensive to do everything today. Uh, and the rent prices are kind of, level off there for a little while, but they're also going up too. So, when you take it into context, and then you take it into the compound effect, if you're going to be in a place for at least 3 to 4 years, I've shown you some charts on this before. Obviously, you probably would want to, be in a property long term if you're purchasing it. But if you're going to be in a place for at least 3 or 4 years, it makes sense to buy it because of compound, your compound effect, your compound interest. It's like, you know, um, when you take into effect the fact that you're buying down the principal, the property value goes up over time. You're getting a tax advantage. Okay. And you'll look at, the fact that you could even rent that property out, or, down the road if you wanted to. It's all kinds of things you have options to do. But when you look at, the wealth building, we know renters versus buyers. A homeowner is going to be 44 times wealthier than a renter, on average. So, I mean, all these factors you do have to kind of come into play. And, a lot of this is just, averages, not looking at any of these buy down programs that are available right now. So you have to kind of take it within the context of all that. Okay. So, but when you're looking at some of these metro areas, people are looking at what people are doing. So the number of households grew, second quarter, biggest gains in recent years. The number of homeowners households rose 0.6%, the smallest uptick since 2022. Okay. America's renter population is growing and it costs, climbs. So, and we've got a lot of, people moving here, even from other countries, right? So that plays into that inflationary factor. Mortgage rates, payments up, we have mortgage rates, payments up 90% from before the pandemic, while asking rents are up 23%. Affordability crunch is here. So this article kind of goes into the details of that, and kind of how apartment demand is growing, is growing over the last few years, and how multifamily completions are annualized, renter household year-over-year growth has increased, all those factors. Okay, so when you look at, I think we've got, let's see, Phoenix here. Is it Phoenix? So yeah, uh, let's see, 30.3% rentership rate and home ownership rate for Phoenix is up 30.3% on renters and 69.7% on the home ownership rate. So you've got these numbers kind of climbing here, and but again, if you look at the average lease price, I come back to that. Okay. And I come back to the idea that if you own the home, obviously you're gaining equity. If you're renting, it is a 100% interest rate, 100%, because it just goes out the window. Uh, Now, here's the other side of it. Home buyers gain nearly $30,000 in purchasing power over the last month, thanks to mortgage rate drop. What do you mean? Well, we've seen that, as mortgage rates dropped from over 8% down to where they are now, we've seen a surge back into the market, especially in the past week. So again, this is across the country, but home buyers on a $3,000 budget can afford a $466,000 home with 6.35% mortgage rate, roughly the daily average. On August 5th, the buyer has gained nearly $30,000 in purchasing power over the last month alone. They could have purchased a $437,000 home with a 7.15% rate, roughly daily average at the start of July. Okay. The same buyer has gained more than $40,000 in purchasing power since April, when mortgage rates hit a 5-month high of 7.5%. Okay. How much home can you afford? And it goes into the amount, and then, what you're paying for a property, what your payment might be. Again, these are fixed. These are not any of those buy down programs I talked about, any seller concessions that are coming along with that. Um, if you took it says here, if you took a look at affordability another way, the home mortgage payment on a median priced US home, which goes roughly at 443, is 2842 with today's average mortgage rate. Just 1 month ago, the payment would have been $3,000, nearly $200 more. Okay. Here's one other thing I'll just throw out there too, on top of this. If you look at, a $10,000, let's say you're looking at a house that's $400,000, and you're like, hey, Chris, can we get it for 390? Now, if you're paying all cash, that's definitely something to look at, especially now. But if you're getting a mortgage, especially, you know, especially if you're putting just like the minimum down, which on FHA would be 3.5%. Conventional could be anywhere from 3 to 5% minimum down. Um, you know, and there are 0% down programs. Now, obviously, your rates going to be higher on that. But if you look at the $10,000 difference in a mortgage payment, by getting that price reduced, that's great. You're going to save about $78 a month. Okay. And you're going to owe $10,000 less on the property overall. But if you get a rate buy down, and let's say we got that bought down, we're talking about, multiple percentages here with these buy down programs. But if you look at a 1% difference, you could be saving about $250 a month, almost $250 a month. If you got a 1% lower rate, we're talking about buy down programs where your rate is starting in the ones with these 3-2-1 buy down programs for the first year, and yeah, it goes up second year into the twos, third year into the threes. Some of them cap right there, or they go into the fours the following year, and then they stop and fix. They don't go up anymore from there. It's not like the crazy stuff we were doing back during the crash, like I was talking about. So all this, knowledge is power. You've got to know kind of the whole picture and what's being said there. But Einstein said there's no greater force basically than compound interest out there. There's nothing greater than that idea of compound interest. And when you purchase a home versus renting a home, you have compound interest. Okay. Um, so quick stats. We're at right now 4.17 month supply. We've had active listings go up just 0.2%, nothing crazy, still in the 18,000s, pending 3.3, up a little bit. And then we've got closed units are actually down. And we've, historically a little sales volume. Again, we've had that for a while now, not the number of prices, but the number of actual sales. Okay. But closed units down over 13%. Again, most of the inventory is going to be in the lower price points. Our luxury market's going to be starting right around $1 million now, $1.5 million, right in that range, typically in the greater Phoenix area. Most of the inventory is, if you look at the percentages here, going to be in that 400 to $599,000 range and below. So that makes up what that is like over 60% of the entire MLS. And we don't see any crazy numbers in the short sales lender owned HUD stuff. Again, across the country, it's kind of the same bag of worms there, as far as distressed properties, foreclosures, all those sorts of things. Um, the percentages are up, but you got to look at the actual numbers, and that's where they get you with the clickbait stuff on YouTube. So when we look at supply and demand, we look at the Cromford Market Index. Under 90, we're in a buyer's market. Over 110, we're in a seller's market. Right now, we've just been hanging here for the last few weeks at right around 100. 100 being dead center at balance. We were in a normal balance market. When these two numbers of demand and supply are the same, we're in a balance market. Guess what? They're pretty much the same. Our demand is 27 points below where it should be, and so is the supply. Okay. As far as all of our areas proper, cities proper, we see that Fountain Hills tops the list as a seller's market. Chandler was topping the list there forever. But Fountain Hills is topping the list at 173 on the Crawford Market Index. It's up 12%. And so a little bit of an advantage to the seller there. Nothing crazy. Again, to put it into context, when we had those anomaly years, we were up near 500 on the index overall. So crazy sellers market back then. So nothing crazy. A little advantage to sellers, along with Chandler, Avondale, Scottsdale, Phoenix proper, Mesa, Glendale, and Gilbert. Those are all sellers markets. When we look at uh, Gilbert, yeah, Gilbert was 113 at the bottom of the list on the sellers cities. Paradise Valley at 108, Peoria 105, Tempe 102. and Cave Creek at 92. Those are all in balance markets. And then the advantage to the buyer is going to be beginning at 86 on the index, with Goodyear, then Surprise, then Queen Creek, then Maricopa City, and then Buckeye. Wow, at 64. So advantage to buyer big time in Buckeye in those other cities there. So guys, beyond that, the couple of hot spots. We've got a little bit of a hot spot in Chandler. There's a couple of spots in Glendale, Surprise, and Tolleson, along with North Phoenix. They got a couple of hot areas on contract ratio. That gives us a little bit of a head of the curve look on the contract ratios, even ahead of the Crawford Market Index. So those areas are a little bit hotter than the rest of the valley. And then our active listing weekly counts are pretty much holding steady. Nothing crazy going on there. We don't see any surge in inventory because it's all about supply and demand, right? Get way more supply than demand. We could see definitely see price reductions at that point. We are not. Oh, one thing I did forgot to mention to you on here was that our list to sales price ratio, again, the average sales price has been kind of hanging at that around that level of 563. Again, a lot of that is got to do with these numbers here in the lower end, making up most of the MLS. So, but the list of sales price ratios actually pretty healthy at 98.07. Anything just over 98% is usually good. That's pretty healthy number there for us. So that's where we like to be in the greater Phoenix area. Um, so guys, if you have any other questions at all, feel free to reach out. Keep an eye on, we'll keep an eye on things here for you every week. Again, I would advise everybody to kind of get ahead of the curve now. If you're thinking about making a move, you're gonna miss all that crazy competition that's going to be out there with the buyer demand as the rates drop. And get your property on the market right around now, because as people are starting to enter back into the market, and seasonally, yeah, things drop off usually this time for us because people are going back to school. But right after Labor Day, we do get a little bit of a surge in our inventory right up until Thanksgiving and the holidays. So now with the rate shifting a little bit, we're starting to see application numbers go up, offers go up as far as the number of volume there. And that's the beginning stages of people kind of coming back into the market with these lower rates now, these buy down programs, all these things that are available that, aren't going to be available as much when things shift, a lot more. So if you have any questions at all, feel free to reach out. I'd love to be able to help you with any of your, home evaluations, home searches, whatever it is that you're trying to do. We would love to be able to help you out there. Thanks a lot. We'll talk to you soon.